Welcome to Market Dive. Today, we're digging into a really powerful investment thesis for gold, one that's not just talking about a temporary price spike, but a full-blown structural bull market with a very clear path forward.
Okay, let's just jump right in with the bottom line first. $4,200 an ounce. Now that's the base case price target for gold by the end of 2026, and it's based on a consensus of serious institutional research.
So how in the world do we get to a number like that? Well, we're going to start with the core thesis, then we'll build the case on two huge structural pillars. After that, we'll add some fuel to the fire with what we're calling the cyclical engine, map out the potential scenarios, and wrap it all up with an actionable playbook for investors.
All right, let's kick things off with the big picture. The argument that gold is making a major shift, moving from just a simple hedge to an absolutely essential core asset for preserving your capital.
Right, so the key thing to get here is that this isn't about trying to time some short-term market swing. No, we're talking about a fundamental, deep repricing of gold that's being driven by these massive, long-term trends.
Okay, so now let's get to the foundation of this entire thesis. What's actually holding all this up? Well, it builds on two incredibly powerful, long-term global shifts.
All right, pillar number one is what you could call the great de-dollarization. What we're seeing is a historic pivot by the world's central banks. They are actively and strategically moving away from the US dollar, and they're aggressively snapping up gold instead.
Now, what's really fascinating when you look at these numbers is just the sheer scale of the buying. I mean, since 2022, central banks have been consistently hoovering up somewhere between 25 to 30% of the entire world's annual gold production. That creates this huge and, pretty price-insensitive floor under the market.
And this quote just illustrates that strategic shift perfectly. Think about it. It's a very deliberate choice. They're choosing gold's neutrality and its lack of counterparty risk, which, just means it doesn't depend on someone else's promise to pay, over the yield they could get from U.S. debt. That signals a massive change in how global reserve managers are thinking.
Okay, on to the second pillar holding this whole thing up, the deteriorating fiscal health of Western nations, especially the United States. This is seriously eroding confidence in those traditional risk-free assets and forcing investors to look for other options.
$37.5 trillion. That's the U.S. national debt as of late 2025. And a number that big, well, it forces a long-term policy bias. It pretty much guarantees a future of lower interest rates and, frankly, currency debasement just to keep the interest payments manageable.
So with that structural foundation firmly in place, let's look at the engine that's really set to kick prices into a higher gear in the medium term, U.S. monetary policy.
So to really get the next catalyst, we have to understand this concept of real interest rates. Honestly, this is probably the single most critical cyclical driver for gold, period.
Right, so the crucial takeaway here is this really powerful inverse relationship. When real rates fall, the opportunity cost of holding a non-yielding asset like gold just plummets. It becomes way more attractive compared to, say, bonds or cash that are actually losing purchasing power to inflation.
And the current outlook points directly to exactly that, falling real rates. Why? Well, it's driven by the Federal Reserve's big pivot to an easing cycle. That not only lowers the nominal rates, but it's also expected to weaken the US dollar. That's a powerful 1-2 punch for gold.
Okay, so given these powerful forces, both structural and cyclical, what's the range of potential outcomes we could see for the price of gold by the end of 2026?
Well, the institutional consensus is overwhelmingly bullish. I mean, just look at how tightly clustered these forecasts are from the big banks. They're all looking at the exact same drivers we've just talked about and coming to very, very similar and very optimistic conclusions.
The most likely path, with about a 50% probability, is the base case. This gets us right to that $4,200 target. And this scenario doesn't even need any crazy shocks to happen. It just assumes that the trends we're already seeing, falling real interest rates and strong central bank buying, just keep on going.
Now, the bull case, this is what could push gold over $5,000 an ounce. This would probably be triggered by a significant economic shock, something that forces the Fed into much more aggressive action. We're talking full-on quantitative easing, money printing. That would send investors scrambling for a real safe haven.
Of course, while it's less likely, there is a bear case. But for this to happen, you'd need a complete 180 on basically all the current trends.
We need a surprisingly strong global recovery, inflation would have to fall off a cliff, and we need a major de-escalation in global conflicts. It's a high bar.
All right, so let's move to the final section and make all of this really actionable. How does this all translate into a strategy for your own portfolio?
While the analysis suggests a strategic allocation to gold is definitely warranted, and you'll notice these weightings are quite a bit higher than what you might see in traditional models, that's because it reflects gold's evolving role. It's not just a hedge anymore, it's becoming a core asset for preserving wealth.
But, and this is a big but, given how much the price has already run up, probably the smartest way to get in is using dollar-cost averaging. By investing a fixed amount regularly over, say, the next 6 to 12 months, you really mitigate that risk of buying at a temporary peak, and you build a much more stable long-term position.
And finally, it is absolutely crucial to be aware of the main risks that could challenge this whole thesis. These are basically the triggers for that bear case we just talked about. A hawkish Fed, a surprise economic boom. Any of these things would be a clear signal to step back, reassess, and adjust your strategy.
And that brings us to the final, crucial question that this whole thesis is really grappling with. As confidence in traditional government assets gets tested, is gold just shifting to be a temporary safe haven? Or are we witnessing something much bigger, a fundamental shift in what the financial system considers the ultimate store of value? The answer to that is going to define the next decade of investing.